Our main focus point today is about retirement planning and 3 tricky decisions every retiree tends to face. And as more and more people rely less and less on pensions, right? I think it's only 1 in 4 baby boomers have a pension of some type. So it means that managing things like taxable withdrawals from your accounts, dealing with RMDs, appropriate asset allocation, these are all aspects of retirement planning that can be challenging. But there are 3 that really depend on your situation and the current market situation when it comes to insurance as well as the investment side. And so those include withdrawal rates, long-term care, and annuities. So let's bite one off at a time. Now, the first one is withdrawal rates. And everyone asks, how much money can I withdraw each year safely? And the answer is simply unknowable. There are too many variables for anyone to give you a solid 100% answer. Okay. But you have to really start somewhere. Okay. You have to look at what your likely life expectancy is. Even though you may only live 15 years, you also might live 40. Also, you don't know what asset classes will return over those 20, 30, 40 years of retirement, but you can have a pretty good guess based on valuations and history. And you don't know where inflation's going. So is inflation going to continue to stay around 3% or more? Probably. We think 3% is more of a base case going forward, but that's just an educated guess, just like anybody else. Now, research conducted in 2021 suggests that a 3.3% withdrawal rate was a safe starting place for retirees. The issue, though, was that back then, equity prices were very, very expensive and interest rates were very, very low. So the expected forward return for equities was very low, and the expected forward return for bonds was also very low. Now that's shifted. As of late 2023, it actually, based on equities falling in 2022, having a little rebound in 2023, but still cheaper than they were in 2022, so a better longer-term equity return expectation. And then yields were higher as well. So now if you invested in bonds, well, now you're getting a much better yield. Instead of 3 or 4%, in many instances, you're getting 5, 6, 7%. And at the end of last year, because equities rallied and became expensive once again, the safe withdrawal rate was 3.7%. And this is assuming a balanced portfolio. Now, everybody can be different, right? And so you have to look at older retirees. Well, you can have a little bit higher withdrawal rate than younger retirees. And then also you need to be flexible. So if the market's down, your portfolio is down, you have to be flexible too. Maybe you take one less vacation that year. Maybe you don't splurge as much on the grandkids for Christmas that year, etc. And then try to maximize your non-portfolio income. This is where retirement or Social Security planning comes in. Maybe a pension, an annuity, rental income. These are other sources of income besides just your investments. So delaying Social Security and the Social Security strategy is one big example of that. It's something we help our clients with when we develop financial plans for them. So when we have a client, it's not just the investment side, it's also the planning side as well. And this stuff is included. This is part of what we talk about. And then there's long-term care. And it's uncomfortable. Why? Because if you have to use long-term care, it's losing independence. But about half of retirees need long-term care at some point. And that's a pretty good odds that you will need long-term care. And most of that long-term care is not covered by Medicare unless you don't have very much money at all. And you go beyond just a rehab stay after the hospital. Genworth said that long-term care A year's worth of long-term care costs about $111,000. That's up 7% from the previous year. Now the question is, do you need it? Well, ideally, if you have enough money, you self-insure, meaning you put money aside for that long-term care at some point. For example, when you turn 85, there's an exponential increase in your potential need for long-term care, to go in a retirement home, etc. And so you have to think about that. Now, if you're somewhere in the middle, you're not too poor to qualify for Medicaid, then you probably want to self-insure. Or sorry, you probably want long-term care in some way. The problem is that a lot of insurers have just resigned from the industry as a whole. And there are a lot of hybrid products that are riders on top of existing life insurance policies. So a term life with a long-term care policy is probably the best way to go if you're going to go in this direction, or a fixed annuity along with a rider like for long-term care. That would probably be the best way to go. And this feeds into the last one, which is buying an annuity. And this is pretty simple. Only if your Social Security income needs don't fulfill your basic retirement expenses, that's when you may want to opt for a fixed annuity only. Okay? There you go.